Are we on the brink of a new global recession? In recent weeks, we've witnessed wild drops in stocks, bonds, and even Bitcoin itself. Practically all major US tech companies lost between 4% and 12% of their value in just one trading day. And the VIX index, which measures volatility in Wall Street markets, has reached levels only seen during the pandemic and the 2008 financial collapse. But what exactly is happening? How serious is this situation? What consequences could it have for the global economy? In recent days, you've probably heard a lot of different explanations, concepts like the Japanese carry trade, a bubble bursting in tech companies, or even that the US economy is in decline. In this video, we'll talk about all of that. Hello to all the community of Finance for All, welcome to another video. In recent years, tech companies have been the spearhead of the Western economy, and there's no better proof of this than Joe Biden's industrial policy. Biden has been encouraging tech companies to invest in the United States. That, combined with strong corporate earnings and the arrival of artificial intelligence, has skyrocketed expectations. As a result, the US stock market, where these companies hold significant weight, had been hitting record highs month after month. But now, suddenly, everything has gone awry. If any sector has been hit hardest by this stock market crisis, it's been the tech sector. The question is, why? Many point to the bursting of a bubble. Remember the dot-com crisis? When the use of the internet began to spread worldwide, investors went crazy over tech startups. Shares of internet-related companies soared, often without solid foundations or even viable business models. It almost seemed like if you had an online business, you were destined to become rich. And yes, it's clear that the internet was a paradigm shift for the global economy, but the hype of that time was excessive. Many projects didn't have viable business models for the era or needed much more maturity. Something similar could be happening now, but not with the internet, rather with artificial intelligence. Think about it, a new technology that promises to change the world as we know it, and in which all the startups are diving in headfirst, including ourselves. The question is, could we be experiencing an excess of hype like we did with the dot-coms? The answer is yes, it wouldn't be far-fetched. To give you an idea, companies like Nvidia have seen their stock market value increase sixfold in just 3 years. If you had invested $1,000 then, you would now have $6,000. But do you know who the main beneficiaries of this rise have been? Nvidia's own employees have been among the primary beneficiaries. Many of them were compensated with stock options, meaning instead of receiving cash, they received company shares as part of their salary. Considering we're talking about high salaries for computer engineers and programmers, this is significant. Recently, a survey was conducted among them on an employment portal, and thanks to the company's revaluation, more than 36% of the employees surveyed now have a net worth exceeding $20 million. Of course, the survey may have its biases, but the fact is that Nvidia now faces a problem with retaining professionals. Many have become millionaires from the stock and are choosing to retire to enjoy life. All of this seems great, but isn't it strange that companies like Nvidia have multiplied their value despite the high interest rates over the past few years? When rates are high, there's less money in the market because banks lend at a higher cost. Despite this, investments haven't stopped. Where is all this money coming from? There are two options: either investors have such strong confidence in artificial intelligence that they're injecting more money than expected, or there's a credit bubble on top of a tech bubble. Which of these hypotheses is more likely? There are arguments for both. In the last quarter, most major tech companies like Google, Amazon, and Microsoft have reported revenues below expectations. This is largely because the US economy is also weakening. In other words, when interest rates are high, families and companies take on less debt, spend less, and gradually economic activity slows down. This is positive for moderating inflation, but there are suspicions that the Federal Reserve has overreached, and now a new recession could be approaching. The question is no longer whether there will be a recession, but rather that the reality is that tech profits are already lower than expected. This is important because in a low interest rate environment where there's abundant money, if a company isn't making enough profit, it doesn't matter, it can continue borrowing cheaply. But with high rates the story is different. A clear example of this is Intel, its problem isn't so much related to AI but to the fact that its business has been losing revenue over the last 2 years because it hasn't been able to adapt to the rise of competitors like TSMC. Now the company has implemented a restructuring plan to turn the situation around. The goal is to sacrifice the short term to regain strength in the long term. To do this, it has cut costs by laying off 15% of its workforce, cancelled dividend payouts, and started redirecting resources to adopt a new production model similar to that of its competitors. The problem: this is fine when rates are low, and you can borrow, but with high rates, it's a very risky move. Not having profits right now makes it much harder to invest in the long term. To top it off, Intel has been one of the biggest beneficiaries of Biden's industrial aid program, receiving billions of dollars to expand its production in the US. In other words, the fall of this American giant is not only bad news for the company but also a bad omen for Biden's industrial policy. Earlier, we mentioned that there could be a bubble in tech companies for 2 reasons. The first is that the short-term potential of artificial intelligence has been overestimated, and now economic results and sales are not keeping up. But another, much more dangerous reason is that there could be a cheap credit bubble behind this process. And this is precisely where the Japanese come into play. When stock prices experience a rapid appreciation, warning, it's a sign of excessive speculation and potentially dangerous debt levels. And indeed, the US stock market is heavily indebted. This means that investors have borrowed money to buy stocks. Peaks in debt levels often coincide with periods just before major market corrections. It happened with the dot-com bubble in 2007, and right before the post-coronavirus crash. Borrowing isn't necessarily bad, nor is it always a warning sign that everything is going to collapse. What really matters are the conditions of the debt. For example, if you take out a 40-year loan to buy a house, your monthly payments will be quite manageable. But if you borrow over 5 years, the monthly payments will be an exorbitant amount that's impossible to pay. The debt amount is the same, but the terms are different. In recent years, both the stock market and many other assets, like gold and Bitcoin, have been fueled by risky debt, that from Japanese banks. Japan has been characterized by 2 things: first, by having very low interest rates, and second, by maintaining them no matter what. We're talking about rates that have been consistently negative since 2016. This was a golden rule: if you went to Japan, you could borrow money at negative rates, meaning the central bank would pay you to borrow money. Of course, if I'm an investment fund wanting to invest in a tech company but need money and that money is very expensive in the US, I can go to Japan, take out a loan at 0 interest, invest in the US, and make money with almost no effort. This is the famous carry trade you've likely heard about, and it's been used not just to invest in stocks but also in treasury bonds, gold, Bitcoin, and any other asset you can imagine. And now, the million-dollar question: why is the carry trade so dangerous? Think of it this way: if everyone borrows money in Japan to invest in the US stock market, they have to get rid of the yen they've borrowed by converting it into dollars. This floods the market with Japanese currency and reduces its value. If the yen becomes cheaper, the debt that needs to be repaid also becomes cheaper, because when you have to pay back your debt, you'll need to convert fewer dollars into yen. And if everyone does the same, we're contributing to making the yen cheaper and cheaper, which in turn makes debts lose more value. So when does the problem arise? The problem occurs when this spiral breaks, when the yen suddenly increases in value, which is what has happened. Unexpectedly, Japan's central bank raised interest rates to the highest levels in the last 15 years. Moreover, in the US, fears of a recession suggest that dollar interest rates might decrease. And what has this led to? Borrowing in Japan is no longer as cheap, and investing in the US will be less profitable. Even though the difference is small, it has been enough to break the vicious cycle of yen depreciation. The yen has risen 12% compared to last month. What has been the consequence? As the yen rises, investor debts have become more expensive. Many have started to repay those debts because the carry trade business was no longer as profitable. But of course, to repay the debts, they had to buy yen, which further increased its value, making debts even more expensive. Do you see where this is going? Right now, investors worldwide are seeing their debts increase in cost at a rapid pace. To avoid losing money, they need to repay their debts before the yen becomes too expensive. And where does the money to repay the debts come from? From stocks, bonds, gold, Bitcoin, and all those assets where they had invested with Japanese money. In other words, much of the stock market crash we've seen has been caused by numerous investors selling stocks or bonds to get the money they need to repay their debts. How long will the massive sell-offs last? No one knows. In fact, it's very difficult to calculate the current amount of carry trade in existence, but some sources, like analysts at Deutsche Bank, estimate it at around 20 trillion. And you might wonder, why did the Bank of Japan decide to raise rates and start this upheaval? Well, the answer seems to lie in oil. Japan is extremely dependent on crude oil, and having a weak currency made its energy supply much more difficult. This led to Japanese society viewing the yen's loss of value very unfavorably. The Japanese state has simply done what was going to happen sooner or later. Either way, what conclusions can we draw from this video? The first is that there has likely been an excess of hype in tech companies, fueled by cheap credit from Japan. The second is that what we're seeing appears to be a textbook correction. Perhaps the most peculiar aspect of this downturn is that it has affected almost all markets, stocks, Bitcoin, but so far, the decline hasn't been large enough to talk about a financial collapse. Corrections are normal. We've had a long period of significant rises at record levels. It's possible that Japan's tightening of the money supply will continue to drive down stocks, or that there's still an overestimation of tech companies that needs to be corrected. But in any case, companies are still doing well, there are still revenues, and there is good employment in the United States. Maybe less than expected, yes, but the Federal Reserve has plenty of room to cut rates and boost economic activity. And with all that said, the questions are for you. What do you think about the tech boom? Do you think the Japanese carry trade will continue to have an impact? Will this correction lead to something bigger? You can leave your answers in the comments.